Hi, good evening. Today's topic is investments. Investments. Corporate companies invest surplus money in various different types of investments, wherein we get some returns. We get some returns on investments. Corporate companies invest in the various places to get some kind of return. Say, for example, a company is having a surplus balance of say $100,000. Now we have $100,000. $100,000 is not required for say next 45 days. After 45 days I need this money. So company will not keep this money idle. This has to be invested somewhere where you will get some profit. The profit on the amount invested is called as return. So say for example this amount was invested in other company at the rate of 4.5%. So when you calculate the profit on the amount invested, that will be at the rate of 4.5% times, say we invested it for say 35 days, 35 over 360, okay, or 365. This amount is called as profit, but we should call it as return on investment here. Return on investment. How much you are getting is return on investment. So companies like to invest money, a surplus money in various places to get some profit. That profit is called as return on investment. And today's topic is what are the different types of investments a corporate will invest outside. So we'll be discussing about investment. We'll be discussing about a classification of investments, which include trading securities, available for sale securities, and held to maturity securities. Our entire unit will deal with the A, B, C trading securities, available for sale securities, and held to maturity securities. What is the accounting treatment when you buy these securities, when you sell these securities? If you don't sell these securities, what is the value of the securities at the end of the period? And how do you treat the profit earned on the securities? This is what we are going to discuss in the class. And how do you record them? What is to be debited, what is to be credited? And when do you use equity method? When do you use fair value option? And when do you use, the consolidation? First of all, an investment is the energy or time and matter. Matter here it is, excess cash balance spent for a period of time. Say it could be a 30 days, 40 days, like that, to get some profit. Such a profit is called as return, a return on investment. Now here, say for example, I invested an amount of $10,000 for say 45 days. 45 days. Now this is on say November 1st or 1st of October. 1st of October, 45 days. So on November 15th, I received an interest of say 1,200, and at the same time the value of investment is now say 10,300. I earned in two ways. One is interest here for holding this investment for 45 days, and also the value of the investment is gone up from 10,000 to 300, 10,300. So the my total profit here is 1,200 interest earned and $300 increase in the investment. So 1200 and 300. Overall profit will be $300 plus $1200. That is $1500. This is what we are going to discuss here. This is the initial cost of the investment. This is the reporting value of the investment. This is the income earned during the year, and overall profit is 1500. So you are investing your money, that will give you appreciation. At the same time, you will earn some dividends or interest. Investments in debt securities. Debt securities. Please remember, debt security means you invested in bonds, debentures, etc. It is not a share. Share is different. Debt security is different. On the investments of shares, you will get dividend, which is a part of the profit of the company. When you invest your money in the shares, you will get dividend. Whereas when you invest in debt securities, you get interest. This is the difference between shares and debt securities. On the shares, you get dividend, and on the debt securities, you get interest. So now we are talking about investment in debt securities. When you invest your money into US Treasury bonds, municipal bonds, corporate securities, and any commercial papers, commercial paper means it is a promissory note. You will get, interest on this. Mostly debt securities do not change. Say for example, you purchased a bond value of $100 at the rate of say 6%. You will get interest at the rate of 6% during the year, 6% per annum, but the value of the bond will never go up. The value of the bond will never go down. Share is not like that. Bond value will remain same, whereas share price may go up, may go down on daily basis. In a day, 100 times it goes up, 100 times it goes down. We are now talking about investment in debt securities on which you get interest as income. Investment in equity securities means investment into your shares. Shares like common shares. Common shares means equity shares. Equity shares, preference shares, warrants, stock rights, etc., on which you will get dividend. At the same time, you will have also some appreciation or depreciation in the case of the share price. Say for example, you purchased a share in Apple Industries. Apple Industries share price is say for $100. You purchased it $100, and Apple paid you say $2 as dividend. And at the end of the year, the Apple price today is $117. So that $17 is an appreciation in investment. $2 is the amount you earned. That is called dividend. So in this case, you will have an appreciation. You will have an appreciation and also some amount. Say in my example, $100 is the face value. Okay. Plus during the year you receive $2 of dividend, and now the share price is 117. So the investor will have double benefit. One, the return, the profit. Two, the appreciation in the value of investment. But here, when you invest in any bond of say $100, the company promised to pay you say 6%, you will get $6, but your value of the bond at the end of the year will remain same. This is the difference between debt securities and investment in equity securities. Now the question arises that how to report trading securities, available for sale securities, held to maturity securities. Okay, held to maturity securities. Held to maturity securities mean you have to hold these kind of investments until a particular date. Say for example, you purchased bonds of X company whose maturity date is 6 months. 6 months. Say for example, you purchase this securities on say May 20th. May 20th. So May, June, July, August, September, October, November. Okay. Only on November 20th you will be able to get the money. These bonds are held until 20th November to get the money back. This is called held to maturity security. So literally you'll have to wait until November 20th because the period is 6 months here. If it is 5 years, wait for 5 years. If it is 2 years, wait for 2 years. That's the reason why we call them as held to maturity securities. Usually this kind of securities will be long term investments. So you'll have to hold for some time to get your money back along with interest. But if at all you want that money back in a short period of time, this is the investment or has to be ignored. Held to maturity securities will be only used when you do not need these funds in short period. Trading securities. These types of securities you can sell anytime, anytime. Okay, maybe you can sell it on weekly basis or monthly basis. Trading securities. It will have a market. Available for sale securities. These are the ones which are not, categorized. Any one of these two types, held to maturity and trading securities. Okay, so we can see that available for sale securities are nothing but trading securities. All right, but here we can sell these securities for any at any moment of time. No need to wait for any time. Okay, so trading securities, available for sale securities, held to maturity securities. There will be a broad classification between these three, but we can say only two. Second and third type of securities are of short term, and held to maturity securities are of long term. So the classification of the securities, whether they become held to maturity, trading, or available for sale securities, are purely based on the classification, that is the management judgment, whether you invest for long period or short period. How do you record the when you purchase the investments? All the three types of investments ought to be recorded at cost, at what price you purchased, at the time of purchasing. Here I mentioned here initial recording of all investments. I purchased an investment. The entry would be debit investment account, credit bank account. What price you paid for? $50,000. Debit investments 50,000, credit bank account 50,000. They ought to be recorded at cost. At cost. End of period reporting on 31st December. Here you need to concentrate much. Initial recording will be same for all the three different types of investments, but end of period reporting will be different from each other. We'll see in detail. In the case of trading securities, all right, the beginning purchase value should be recorded at cost, right? And at the end of the year, these are to be presented in the balance sheet at their market values. Say, for example, I purchased the share of Apple Industries, like my previous example, at $100. I received a $2 dividend during the year, and At the end of the year on 31st December, when I close my books, my profit and loss account and balance sheet are prepared, and on this day it is $117. This is initial cost when you purchase on January 1st. This is the initial cost, should be recorded at cost. This is a fair market value. I did not sell any shares now. I did not sell any shares. So the fair market value is to be recorded in the balance sheet. BS stands for balance sheet. That is 117. But what is the gain here? $17. Did I sell the investment? No. Therefore, it is called as unrealized gain. I did not sell the investment. Therefore, this $17 is called as unrealized gain. Unrealized. Only this would be realized when I sell the investments. There could be loss also. This is 117. What happens if it is 93? There is a loss of $7. Unrealized loss. So there could be a loss. There could be a gain also. Okay. So we understand now what is initial recording, what is income on investment, what is unrealized or unrealized gain or unrealized loss, and what is to be reported at the end of the financial year. Now learn one by one. We learnt trading securities. Now the second one is available for sale securities. Obviously the initial recording should be at cost, ending should be of fair value. Unrealized gain or loss should be reported as a separate component in your retained earnings, and that should go to stockholders funds, shareholders funds, also called as shareholders equity. Why? Because these shares may be decreased, the share value may be decreased in the future. Therefore, until then it should be kept in a separate account, that is called separate component in shareholders equity. So in case of trading securities, what we learned was beginning at cost, end of reporting fair market value. Unrealized gain or losses should be treated in income statement. Whereas in the case of available for sale securities, what happened? Yeah. Now please observe here, as we discussed here, one the trading securities we discussed that they are to be shown under at cost in the beginning, at fair market value in the ending balance sheet, and if any unrealized gains or losses are there, they are to be included in the income statement. Now let's move on to the next investment, which is called available for sale securities. As we already discussed that this amount is to be recorded at cost in the initially when you acquire them, and at the end of reporting period we should show them at fair market value. The unrealized gain or losses are to be reported as a separate component. This is the difference between the trading securities and available for sale securities. In available for sale securities, we are showing as a separate component, but in the case of trading securities, we are transferring it to the income statement. So if there is a gain, that will increase your profit because you are showing in the current period. If there is a loss, your current year profit will decrease. So you please keep in mind, out of those 4 points, for three different types of securities, we discussed so far two different types of securities: trading securities and available for sale securities. Now we'll move on to the next one, that is held to maturity securities. In the case of held to maturity securities, as we already know that initial cost should be recorded at cost, but the ending period amount should be reported at amortized cost. Amortized cost means if you have any debt securities at the end of the period, record it as you purchased. Means beginning and ending amount will remain same. What happens when you receive money? If you receive any dividend, interest, etc., etc., that will go to income statement. Now I will show you one table which will you can easily understand from this table, and please write down this one better so that you can answer any type of questions here. One, here held to maturity, trading securities, available for sale securities. I please write it down. In fact, it is taken from your textbook only, but better to write and report in your in the financial statements. Held to maturity, debt security. Recognized gain or loss? No, because it is to be prepared at amortized cost. Trading securities? Yes. Whether it is a debt security or equity security, still yes. Available for sale securities? Of course, yes, but this should be recorded as a component in shareholders' equity. Recognize unrealized holding gain or losses. Here, held to maturity security is not applicable at all. Here it will go to earnings, and here earnings. Ending reporting period. Ending reporting period, amortized cost, and in all these cases it is fair value. I prefer you to write down this better so that you can answer any number of questions. I'll just stop recording so that you can write it down. Now, the next topic is about investment in other companies. To what extent we invested? Let me give you an orientation. Say for example, this is a company, A, and one company B. Company B investment. How much of that capital is invested by company B? Say for example, you have $100,000. You have $100,000. If company A is investing 15%, it is called investment. Just investment. That is up to 15,000, 18,000, 19,500. It's okay, fine. But if the investment is, say for example, between 20 and 50%, means 20,000 and above but 50,000 below, we need to use equity method. Equity method means you will have a parent and subsidiary relationship between these two companies. In that case, A will become parent company and B will become subsidiary company. A becomes parent, B becomes subsidiary. If the investment in this is more than 51%, greater than 51%, alright, company A will rule company B. Company A will rule company B. Means company A will have controlling power. Controlling power of entire company B is in the hands of company A. Therefore, consolidation is required. Consolidation means you will have company A balance sheet like this. Company A balance sheet is to be prepared. When you prepare company A balance sheet, A, B, and total. So you'll prepare like this. To the extent of your investment, if it is 51%, 51% of B will be here, 100% of A will be here, and the total will be recorded here. Say for example, you have a cash balance of say 200,000 and you have a cash balance of say 30,000 here. 30,000 times 51% will be recorded here. And this amount plus this amount will be recorded here. This is called consolidation. So condition is very clear. If a company's investment is held by another company, we'll have to see the portion of the company's investment. Based on the size of the investment, we will decide whether it is an investment, whether it is an equity method, that is parent and subsidiary relationship, or whether we should use consolidation. All right.